Hello everybody, hope you guys are doing well, having a great day or a great night. And in today's video we are going to talk about why it is not likely that the Fed will change rates right now. So we talked about this before, but just a heads up. Until something break, they are not going to make a move. So there is no crash in the house market. There is the unemployment rate is about to go up, but today it's okay. Uh, there is no crash in the stock markets as well. So everything seems to be fine, that everything's okay, there's nothing bad going on. But in reality, that's not the numbers say. And here I'm going to show you guys some numbers. So this is not an opinion. And also I'm going to share with you a tool that I developed. So we add the numbers and then it is going to tell if it is a positive thing or negative. So if the US economy is or not in a recession. So again, it is not a opinion. It's not a tool for opinion. Okay. Of course, there is nothing like it is 100% because it can stay a bit in the negative territory to then come back. So it's kind of close to zero, a little below, a little up, but you guys will understand. So the GDP, the last three reports, we have a trend here, okay? So 49, 3 and 4, 1 and 3. So if this trend continue, we are about to see something close to zero or even maybe negative territory here for the GDP. This is maybe a clue about one thing that is about to crash. Actually, is not a crash. To go into the red territory. Okay, forgive me. And so a negative or let's say zero GDP could trigger the Fed pivot. I think so. The GDP is something very important. And imagine how this could be changed. So if the Fed pivot, the GDP would go up? Most likely yes, because cheaper loans, easy credit, people going back to buy again, buying stuff, expensive stuff, so on and on. So it's likely that it can trigger the pivot. Uh, what else? Let me see, just a second. Yeah, but again, we need another report. If I'm not wrong, we will have one in August. I have to check it out. Okay. But again, it's a trend. And we do understand that the interest rates as it is today, it will keep hurting the economy. This is a fact. It is going to happen everywhere, not only in the United States. Okay. So it is something to keep an eye on. So now we move to the job reports. Uh, some people were expecting 160,000 new jobs. In my opinion, all these numbers are made up, just like the inflation report. But again, it's close to the reality. In my opinion, it is not 100% accurate at all. So it should be great that the number of jobs keeps going up, right? But that is great in a healthy economy. With inflation, the number of jobs growing, we have wage inflation, which is bad. And again, more people employed, more people will be spending. And spending in an inflationary scenario, it's bad because it all adds to inflation. Whatever is, if people it's buying a car, a home, a boat, land, whatever, it all adds to inflation. There is no way to avoid it. Okay, so this is another thing to take a look because there is no trend here, but a sharp decline in the next report can be a good sign about the Fed pivot. So this is the news release for labor statistics. This is very important, folks. Very. Doesn't appear to be, but it is. This little chart here, we love charts, right? We love candles, lines, dots. And what we can see here is a macro chart, okay? From May 2022 into May 2024. And what we can see here was consolidation, and now we have continuation, which means, again, unemployment rate seasonally adjusted from May 22 to May 2024. So unemployment rate will keep going up. Okay, so this is a fact that this little chart is telling this. So now we have possible GDP going down again for 4 quarters, uh, unemployment going up, maybe employment rate probably will go down. So maybe we are starting to see the numbers, talking to each other. The line is getting closer to each other for something to break. Of course, we are not going to see just a local event to tell all these things. No, I still believe that we look at all of it, then we make sense, and then we connect the dots. Okay. This one, there isn't a clear trend here. So it's the non-farm payroll here. So there is no clear trend, but we can see that the lowest, uh, the bodies with lowest volume here, they are starting to become bigger. It's kind of higher low, higher low, higher low, similar to that. And it seems, so even if we have a lower high here, I'm just reading like a asset, okay, because charts, they tell a lot. It's very important. So maybe there is a clue that we are going to see changes here as well. So we have to keep eyes on in this guy as well. So this one, you guys can take a look. Let me go up. So Freddie Mac, you guys can check it out, but you can also find this data elsewhere. So total for sale and for rent, vacant housing is 1.5 million units below a balanced market. So some people may say, well, this is a crash. No, it is not a crash. Why? Because the number of people looking to buy homes is still high. So they are looking for a better deal, whatever is a cheap loan or a price discount. Okay, so it is not just because people are not buying that the thing's collapsing. We have to remember that there is sort of a bubble where price of homes, not only in the United States, but elsewhere, from Brazil, Australia, Germany, Argentina, many, many places. So the prices were growing so fast, and it's becoming almost impossible to buy a simple home. Because it's very, very expensive. It's out of reality. Okay. And so maybe all those people, because every day there's people looking to buy a home, they want to live with their families, or just got married, looking for a new home. And so these people are going to buy. But at this time, it seems, or for at least what I can see here, there's a lot of people who are renting, not buying. So they are waiting for the right moment to jump in and buy, home or land. So this is not there. It's no crash at all. Okay. And I do believe, now it's my opinion, that we are going to see this getting close to zero. Okay. Just a thought. So here we have so this is one of the sides of debt, okay? Household debt and credit report. So this is from the New York Fed. Total debt balance, no housing debt. It's 12 trillion. No, it's not 12. Housing debt. 12 trillion non-housing debt for almost $5 trillion, folks. So it is insane, right? Let me see. Yes, yes. It's insane. And also the credit card debt is way above $1 trillion. So whatever the place we look at here, whatever the data, whatever the sector, whatever the fundamentals behind it, we can see by a matter of fact that things are not healthy. They are not good at all. And it's actually there is problem everywhere. Okay. And this is concerning. It's dangerous. Okay. The question is how long the market, can keep going without the crash that we know it's coming. It's when I see people bullish in the long term, it's actually insane. It's looking to a bomb that is about to explode and say it is a flower, everything's fine, nothing's going to happen. So it's very dangerous. And now, probably one of the worst things. We already talked about this as well, explaining to you guys with details. So the US federal debt to GDP ratio right now, believe it or not, is at 122 and 29%. According to the World Bank, the health economy has its debt close to 77% of its GDP. So the United States is a tick-tock bomb about to blow. Okay? So again, folks, whatever the place we look at, whatever the numbers, whatever the data, it's completely wild. It's insane. Not to mention the US national debt, almost $35 trillion. This is insane, right? But it is what it is. Now I want to show you guys the tool. First, I'm going to give you one example of one model that I made many, many months ago. When was I was drafting, and trying to find a way, trying to figure it out, and then I came with this solution. So let me show you right now. Okay. So the upper triangle stands for the GDP. The left one or the right doesn't matter. So the one on the left is for inflation, and the one on the right stands for interest rates. Okay, so this was probably when the Fed started to raise rates when I did this, if I'm not wrong. So how it works? In the middle we have the result. So GDP it's a plus, it's positive. Inflation and interest rates, it's a negative event. Why? Inflation hurts the economy, so does interest rates. Okay, uh, so in a scenario that we have inflation, let's say have inflation, the only way to fix it is with high interest rates. But this is not the scenario we have right now. Okay, but even if it were, the outcome would be the same. Okay, because interest rates at 10, 15, or 20, 18, Paul Volcker, it is going to hurt the economy, but it's the only way to fix inflation. There is no other way, right? So it is going to happen again soon. The question is, some people are talking mid 2025, maybe late 2025. Then in another video, we are going to talk about it as well. Okay, so you guys got it. Both hurt the economy. GDP is when GDP is healthy or going up, it's because the economy is doing great, right? But inflation, interest rates, they hurt the economy. It's actually very simple, folks. So GDP, it's a plus. Inflation and interest rates, it's a negative. So what we do, we sum both negative, which is going to return a negative number. Then we do the math. GDP less inflation and interest rates number. And then we end up with a result. Okay, so in this case, it resulted a minus 4.8. So of course, a single quarter doesn't turn into a recession. Okay, but again, staying close to it and multiple times or even touching, it's bad. Okay, because it's health, it will stay above, not below. So when I did this, the number that I got, it's a bad number, right? And now we have a bad number again. So just like I told you, it keeps going and going. So the numbers that we have today, you guys can do this by yourself. So GDP 1.3, inflation 3.4, interest rates 5 and 50. So it's A minus B minus C, which returns minus 7.60. So the scenario today, it's even worse when the GDP was actually is now 1.3. So now, so here it was minus 48, and right now we have a minus 760. So all those things, folks, they are not telling a good story with a happy ending, and things are to be very, very concerned, not happy at all. And yeah, so just a second, folks. Uh, it's important to call I must return. So one of the things that I want to tell you guys is some people that are bullish in the long term, they do believe that the ETFs on crypto are going to make everything go, blazing guns, sky high, new highs, insane new highs. But there is a assumption that others are going to pick a lot of money, a lot of their money, and move into a risk market because crypto is risk assets, which doesn't make sense as well. Okay, so all those things, all those assumptions are very, very dangerous. Okay, so just wanted to share these things with you guys, and we will keep track and observing and see how this Fed pivot novel will unfold. We talked about this in the last few videos that if they don't raise rates now, it's likely that they are going to do in September. According to their spreadsheet, their strategy, they said that they are going to do this 3 times this year. So we still have September, November, and December, if I'm not wrong. Okay, so guys, this is it for now. I hope you guys enjoyed this video. I hope this can help you somehow. And let's keep working. Let's keep doing our thing, right? So I will see you guys soon. Stay safe and see ya.